In addition to the significant human cost, Russia's military attack against Ukraine will likely limit economic growth in Europe and strengthen inflation throughout the developed world. In our global portfolio model that guides our multi-asset strategies, we shifted equity exposure away from developed countries outside the US to US equities and high-yield bonds, while boosting exposure to inflation-linked bonds, resulting in a small reduction in risk. Let's take a closer look. At the start of the attack, global stocks fell, led by Europe, while oil prices temporarily pushed through $100 a barrel and natural gas prices rose. Energy dependencies and other economic ties leave Europe with a greater exposure to the economic consequences of the attack. Uncertainty over energy supplies and higher prices threaten economic growth in Europe, while higher commodity prices worldwide make already high inflation more persistent. We will continue to monitor developments, but as of now, we are assuming that Russia will take over Ukraine. We believe Russian President Vladimir Putin covets Ukraine for its wealth of commodities and because he considers all of Ukraine part of the Russian Empire. This likely marks a notable shift in the post-Cold War world order, which may affect investment decisions for the long term. Our downgrade to our European growth outlook serves as the catalyst for changes to our positioning. We've also increased our inflation outlook globally due to more persistent inflationary pressures and the inflationary impact of the war. Much still remains uncertain regarding the extent of the response from the US and Europe. We think potential sanctions against the energy complex in Russia will likely have the greatest economic impact. With what we know now, we want to better protect the portfolio against a more challenging European economic backdrop and more persistent inflation. We reduced the allocation to developed market equities outside the US by 4% to a small underweight, splitting the proceeds to add to US equities and US high yield to reflect the US's comparatively better insulation from the economic fallout. We also cut investment-grade bonds by 2% to add to inflation-linked bonds, reflecting incremental pressures on inflation.